Now, according to Marriott, given the shaky investment environment, investors should focus on managing risk and preserving capital. Mike Ronald from Marriott joins us on the line for more. Good afternoon to you, Mike, talking to us from Durban. Is that a good summary of your attitude?
I think it is, yes, and good afternoon to you, David. It's maybe to say that what we experienced last year is not necessarily going to be repeated in the local market this year, and investors need to look at their investments to make sure that they're properly aligned to withstand some of the pressures that you might get in the year ahead.
How would those pressures be different to the pressures we've seen? And earlier on, Sasha Narishkin and I were saying that if you look at the growth prospects for the global economy, China at 7.4, I think, was the latest number that they came out with. And as we said, you can't go on growing at 10% forever. But the US certainly looking positive, talking about a 3% growth rate soon. And the Eurozone, even there, at least perhaps the bottom is been hit, and maybe there's been a bit of an upturn in most of it anyway, although they still have big debt problems. That's a very different picture to where we were at the beginning of 2013.
I think globally, yes, we are in a different place, and we can see, I think it's now a hackneyed phrase, the green shoots emerging, and in fact more than green shoots in the United States. But locally, I think we are going to come under increasing pressure with earnings, particularly as we have retail spending under pressure and the households just maybe not having as much spare cash as they had before.
Yeah, and that's no surprise to anyone. I think it's a trend that everyone's been predicting. It was interesting talking earlier this morning about Mr. Price and Shoprite going down 4.5% each. I'm not sure that in the last few years there'll be too many days where those two shares, different in their ways, but big retail companies, good companies, would go down by 4.5%. And the point was made that it's easy for foreigners to get out of such shares.
Yes, we are. In South Africa is a very liquid market, as we know, and yes, we are susceptible to these flows. Of course, it's interesting, the share price going down, and yet the earnings reports from Mr. Price this year being very good. So we're seeing this disparity between one stock, which actually has good earnings, and perhaps retail shares being punished a little bit by the market, as they did this time last year as well.
Well, and maybe they're saying, well, we've had a very good time with this share, now's the time to get out because it's not going to grow as much, and people are very demanding with that. Looking at the investment landscape, let's call it, it is an election year, and on the one hand, I suppose the market discounts an election year, but it can't help reacting to it. What's your sense of this year as an election year and the investment landscape?
I think, yes, it is a little bit of a different year. As you say, we have this 4-year cycle, which, by the way, as a side, we've already seen in the results of Matrix maybe being a little bit higher last year than what they had for the last 2 years.
That's a cynical remark, Mike.
But what we are noticing, and at Marriott we're saying, is let's look for security. Go to those companies and look at those companies that are able to secure earnings as well as being able to pay a continuing dividend and even grow that dividend. Because I think we are going to see some industrial action. We're going to see a rand increasingly under pressure, the prospect of inflation coming through, and households having increasingly less money to spend. And so you want to go to more secure counters, companies that, for example, Mr. Price, as we've just mentioned, those maybe in the medical sector, those that provide goods and services that we are going to continue to need as consumers. I think the more cyclical goods and the more luxury goods might come under pressure.
So if you had a sector that you'd like to get into now, if you weren't in it and would like to get into, or a sector that you'd definitely stay in and perhaps consolidate and get a bit more, which would it be?
Several of them. We've mentioned one already, which has unfortunately been under market pressure, and that is the retail sector, those providing goods and services which are absolutely critical. And there you need to do a little bit of asset allocation and not go as a sector as a whole, but pick and choose particular stocks. Perhaps some of your basic banking stocks, stocks that provide, well, if I can tell you what not to go in, is maybe the more commodity-based stocks and the cyclical stocks. Really pinpoint your financial stocks, industrial stocks that are going to provide continuing goods and services.
That was Mike Ronald. Thanks, Mike, from Marriott, talking to us from Durban.